Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and this is episode 10 of my Dow analysis series in which we're going to be analyzing every single company in the Dow. And in this video, we'll be analyzing the 9th smallest company in the Dow by market cap, and that is International Business Machines, ticker symbol IBM. So I hope you guys enjoy the video and we'll get right into it. If you find value in my videos, make sure to like and subscribe so you don't miss out on future content. This is Frank Mularcik. So in the last video, we analyzed American Express here, and actually in that video, we forgot to check off the Caterpillar video as well. So if you guys missed those videos, definitely go check those out as well. But we're going to be analyzing IBM right here. Currently, their market cap is around $128 billion. And the first thing I kind of wanted to talk about was the Kyndryl spinoff. So that took place, it kind of went through November of 2021. So this is just kind of an article, and I wanted to highlight some things. So basically, what they did is they spun off their business that was focused more on technology infrastructure, and they kind of talk about it here. Kyndryl is a major player in the realm of designing, building, managing, and modernizing mission-critical technology systems. The company has 4,000 customers in more than 100 countries, and it generated $19 billion of revenue in 2020. So it was a pretty substantial portion of IBM's business. I think, in 2020, IBM's total revenue was around $75 billion, and around 19 of that was from Kyndryl. So that's a fairly decent portion. So basically, they're just spinning off that business, and the general reason for that is that IBM wants to focus more on cloud and AI and less on the hardware infrastructure aspect of the digital world. So that's kind of the reasoning behind it. Currently, Kyndryl is publicly traded now under the ticker symbol KD, and I think their current market cap's around $3 billion is what the market is valuing them at. So next we're going to look at the Q1 2022 earnings, which were released April 19th, 2022, and they announced revenue of $14.2 billion, which is up 8% year over year. And they basically had the software and consulting businesses and hybrid cloud businesses all had revenues that grew in the double digits, and which is definitely good to see. The one thing they did note was free cash flow. So free cash flow was only $1.2 billion, and it was around $2.2 billion last year, the first quarter, which obviously is hard to compare because that did include the Kyndryl business, which they no longer have. But I think, ultimately that's not the best sign to see that lower cash flow. But as they do note down here in some of the expectations, they are still expecting, they say, $10 billion to $10.5 billion in free cash flow, which is pretty much in line with where they've been the past year or two. And they're also expecting revenue growth at the high end of the mid-single digit range. So that's kind of a vague statement, high end of mid-single digits. So I guess I'm picturing that to be around 6, 7, 8%. That is generally in line with what analysts are expecting as well. I think analysts are expecting revenue growth of maybe around 6.3% or something in that range. So, basically the company's expectations is in line with analysts' expectations, which is not necessarily a good thing to see, but it solidifies the validity of the expectations per se. So now we're looking at the 2021 10K report, which is a report that all companies have to file to the SEC every year. And this beginning part is sort of just like the CEO letter to shareholders. We're going to look at some highlights from that, or at least that I found interesting. So they kind of he talks about the overall strategy, I guess. So we entered 2021 with a series of clear but ambitious goals to strengthen our portfolio, simplify our operations, and broaden our ecosystem. And throughout the year, we continued to align our offerings with the two most transformational technologies of our time, hybrid cloud and AI. So hybrid cloud and AI is really what they are focusing on at this point. And that is kind of what they are niching into and getting away from more of the hardware side of things, I guess, and focusing more on the software. What I found pretty interesting is actually made 15 acquisitions in 2021, which seems to me like a lot, and they spent around $3.3 billion on those companies, which is definitely a lot more than they spent in 2020 on acquisitions for sure. And then also down here, he talked about some of the technologies that they're getting into. So they're leading development of quantum computing, which I think is pretty cool. And they deployed the world's first 127 qubit processor, which is very large. That's all I can say about that, but that seems pretty impressive. And I think it's, obviously I don't think there's, a clear path to a huge revenue stream from that, but I think it's, cool tech that they're working on, and I think, it does have potential in really any application. And they also talked about chips. I didn't even know they were into chip technology. So apparently they unveiled the world's first 2 nanometer chip, which is significantly smaller than 7 nanometer chips. It says they're expected to achieve 45% higher performance than 7 nanometer chips, which I think is pretty impressive. And they also basically introduced a new approach to semiconductor design called vertical transport nanosheet field effect transistor, or VT-FET, which I think is pretty interesting as well, because in some of my classes right now we're learning basically about transistors and MOSFETs, and MOSFETs are very popular, I would say, and very widely used. So if they have this new technology that becomes just as widely used as MOSFETs, like that could be huge for them as well. So a lot of the interesting things going on there. The next thing we're going to take a look at is the balance sheet. So in terms of the balance sheet, to some degree, it's a little bit confusing because of the Kyndryl spinoff, comparing the end of 2020 to the end of 2021, but they tried to basically adjust it as much as they could, basically adding these line items for current assets or liabilities from discontinued operations. So they sort of reaccounted the 2020 balance sheet, and so that we could compare that to 2021 in a better manner, I guess. But one of the first things I see is that their cash position is down about $4.5 billion there, or sorry, $6.5 billion, which is pretty substantial, I would say. And their current assets really dropped about $10 billion from $39 billion to $29.5 billion. And current liabilities, dropped as well, but not quite as much, by about $6 billion. So that actually, if we look at it, gives them a current ratio which is actually less than 1. So they have about $33.5 billion of current liabilities and $29.5 billion of current assets. Generally, that's not something you like to see, and I would say it's not the best sign for IBM's balance sheet, but I think, at least from my perspective, it'll be more important to see what happens next year, just because they did have that spinoff, and sometimes that kind of stuff can just be a little wonky. So once they get a full year without that spinoff, really affecting them at all, I think it could possibly make a difference. Maybe not, maybe I'm totally wrong, but current assets, down substantially. That's going to make sense since they basically don't own, part of a business that they owned last year. And current total liabilities are down substantially as well because they have less liabilities from that business as well, which is also good to see. So overall, I would say the balance sheet is, not bad, but I think it could have some room for improvement. They've been reducing some debt fairly decently, from about $54 billion to about $45 billion, so about $9 billion reduction in debt. But when you look at the net debt, it's really not that big of a difference since their cash position is down. So if they reduce debt by about $90 billion, but their cash position is down by about $6.5 billion, that means they really only reduce net debt by $2.5 billion. So I think they're making good progress on the debt, and they have, voiced their desire to continue doing that. So that definitely makes me happy. And I also wanted to touch on the cash flow statement as well, because just to talk about share repurchases, basically they have not done any share repurchases since 2019, which is certainly okay given, the uncertainty regarding coronavirus and, then dealing with the spinoff of Kyndryl. So I think that's totally fine, but I would like to see that start up, again, probably in 2022 or 2023. And also, we'll talk about the dividends as well in just a second, but we can see they haven't really been increasing that much. Definitely been increasing a little bit, but I would like to see a little bit more. When we look at the dividends, the first thing that jumps out to me from this summary here is the yield of around 4.7%, almost at 5%, which for a technology company is really very high, I would say, for most technology companies. A lot of technology companies don't even pay dividends, and those that do, and generally the yields, 1-2%, if that, generally pretty low. The payout ratio, though, is, fairly healthy, given the highish yield, I would say, as well. The thing that is a little bit sad, I would say, is the 5-year dividend growth rate. Like I was saying, they haven't been increasing the dividend that much over the past few years. Basically, the past 2 or 3 years, I think, they've just increased it like 1 penny per quarter. So it's like a 4-cent increase per year, which is not that much at all. But I think, they have an opportunity if they can continue growing revenues and earnings to, grow that dividend a little bit more, which I would really like to see. And now that they're kind of past coronavirus, past the Kindle stuff, they'll have more of an opportunity to do that, I think. And this dividend growth value is not correct yet again. Both of my other sources, Dividend.com and MarketBeat, both said 28 years. So that's what I'm going with. And that does make them a dividend aristocrat, which is pretty cool to see. So next we are moving on to the valuation section. And this time I actually took the price and earnings and PE ratio data and basically put it into a table. And I made these same charts that Macro Trends normally has. But the first thing I did is I actually made 2 of the charts. So this first chart is pretty much all the data they had from 2010 to the present. And we can see, generally the PE ratio has been going up since around 2018. And you can see this kind of trend line, which, doesn't really mean the most. And another important thing to note is the correlation coefficient for the trend line is basically 0.5, which means it doesn't really do that great of a job of predicting the data. And this number right here is basically the average of the PE ratio over that time period. So we can see the average is around 11.6 compared to the current PE ratio, which is around 21 right now. So definitely a little bit higher, a fair bit higher than that average. And then I also wanted to zoom in to the past few years. So this is just since the beginning of 2015. And, again, it's generally been increasing a little bit. And it's been higher, over the past few years. And the average for this time period is around 13.6 compared to, 21 that it is right now. So in general, it's a little bit more expensive than it has been historically. So that's definitely an interesting thing to consider. If we look at the overall technology sector, though, it sort of paints a different picture a little bit. So if we look at the whole sector, the average PE ratio is 23. So IBM would be under that. But the thing is with these PE ratios, I think this is just a simple average. But if we look down here, they sort of have this chart of the PE ratio over time for this sector. And this chart says the current value is around 24.6. And we can see it's sort of in the middle of where it's been over time. It's definitely not the highest it's been, but it's definitely not the lowest either. So not a bad time in general to be buying technology companies, but there still could be argued that they have been more undervalued in the past, which definitely makes sense. And then moving on to the actual industry, they're in the software industry, since most of their business is focused more on software now. And if this is going to load for me, we can see that the average for the software industry is around 85. And like I said, I'm pretty sure that's just a simple average. So I think it paints a better picture to look at this this chart here. And this chart says the number is 29.3, which sounds more reasonable to me if it's, weighted by market cap or whatever. And in that case, sort of a similar picture, I guess, to the overall tech sector, which is that they're kind of in the middle of where they've been over the past, 20 years. Definitely towards the bottom of where they've been over the past few years, like 5 years, towards the bottom of that range. So that's good to see that, the sector and industry are kind of at what you could consider a little bit of a discount compared to the past few years. And we're also going to take a look at the discounted cash flow, of course. So this was actually a little bit challenging for me to do because basically the revenue numbers that I was initially doing or initially using were, not adjusted for the Kyndryl spinoff. So it looked like they were going to go to from like, 70 or 80 billion dollars of revenue down to like 50 or 60. And so then my revenue projections were actually showing like decreasing revenues and then decreasing free cash flows, which is obviously not good to see at all. But then I realized what was going on, and I adjusted those values to basically account for the Kyndryl spinoff, and we get a pretty interesting picture. So right now, like I said, their net debt is around $45 billion. So we obviously subtract that off, and we get a fair value of around $155 per share, which gives us a buy price of $140 per share. And the current price right now is right around that at $141 per share. So I think that this, calculation in itself is pretty reliable. In this case, I think the numbers, are fairly certain, I guess, and there's not a huge amount of variability and wonkiness going on. It's all kind of, slow and steady. And you can see kind of my projections are that the cash flows are going to see a decent drop this year, which based on projections from the company and expectations probably isn't going to happen. But I just try to be a little bit conservative with my cash flow estimates. And then, it's better to have a little bit more of a conservative fair value, I guess, at least in my opinion. So that's kind of what the valuation looks like. And next we'll look at a chart real quick. So first we're going to be looking at a 5-year chart. And the first thing we can see is that they've kind of just been trading sideways over the past 5 years. Haven't really seen much progress at all. Basically, we saw the high of the past 5 years was basically, looks like it was in January of 2018, I think that would be, yeah. So it's been a while since we've been up there, but I think, there's definitely been some struggles over the past 5 years and uncertainty with the company. And if we look at kind of these lines I drew here, there's some decent support around the $100 level that they kind of touched here 2 times. Obviously, they went through it in March 2020, but that's kind of an anomaly, I would say. And then also, there's kind of a trend line moving up over the past, 2 years around here, which puts us around the 120 level right now. And on this time frame, there's also a lot of volume in the 110 to 120 level here and 130 to 140 level here. So those are kind of places that you might expect it to stick around a little bit more. If we kind of zoom in more to the 1 year chart, we can see some interesting things as well. So a lot more volume in the $135 range on the year. And right now they're kind of trading in this kind of upwards channel, which is going upwards, slowly but steadily. And, right now they're kind of towards the top of that channel. So technically speaking, a better time to buy would be when they're towards the bottom of that channel, which would probably be around the 120 to 125 level. So that's kind of my thoughts on the chart. I think definitely a little bit lower below 130, closer to 125 would be better from a technical perspective at least. So to kind of summarize my thoughts on the company, I think they're working on a lot of exciting and interesting technology that has a lot of potential in the future. And obviously I think it has a lot of potential, now to produce lots of revenue and earnings. And it looks like those revenues and earnings will be growing. And I think with the Kyndryl spinoff, they're hoping to have higher levels of profitability, which is definitely good to see. One of the things that I'm a little bit unsure about is all the acquisitions they're doing. To me, when companies are making a ton of acquisitions, that just seems like it is a very difficult task in order to, have all these acquisitions and put all these smaller companies together to sort of fit in with your company in order to make them all, greater as one entity than they were as separate parts, and I guess really that's all, what leadership is about. But I think it just seems to me like it would be hard for companies to do that successfully and effectively. So that is something, I'm watching out for, I guess, but I also don't really have enough time span of investing experience to, see companies do this and, see if it works out for them or not. So that's just kind of my thought on it. I'd love to hear if anyone has any other thoughts on acquisitions in the comments below. The next thing I would like to see is more dividend raises, or higher dividend raises. Obviously, like I said, I think it's acceptable and warranted over the past few years that they've had kind of low dividend raises, but they already raised their dividend in 2022, so I would really love to see a little bit of a higher raise, 5-10%, come 2023. I think that would give investors a lot more confidence in the business. The next thing I would say is the valuation. I think is pretty good at this point. The 140 price is pretty much right around the buy price that my DCF calculation gave us, and I think it would be a better price in the 120 125 range. But for me, I don't think at this point I would want to start a position in IBM. I think the first thing for me would be to do even more research to learn more about the company, and sort of try to get a better picture of the history with Red Hat. Obviously, I didn't really talk about that acquisition at all in 2019. Get a better picture of that and the Kyndryl spinoff and some of that stuff. And really, I think where I would want to be adding, if I got a better picture, would be closer to $100 or $110, which I really think would be a fantastic price for IBM. And I think if I was to consider adding IBM, unless I became a lot more excited about it than I am, I probably would only want it to be 1 to 3% of my portfolio for me personally. So let me know what you guys think about IBM in the comments below. I really appreciate everyone sticking around to the end of the video, and I'll see you in the next one.